Today, we will talk about the cost of capital. Cost of capital is the minimum return necessary to justify a capital budgeting project, such as building a new factory. It evaluates whether a projected decision can be justified by its cost. Many companies use a combination of debt and equity to finance business expansion, and the overall cost of capital is derived from the weighted average cost of all capital sources, known as the weighted average cost of capital. The cost of capital is key information used to determine a project's hurdle rate, which is the amount of money the project needs to generate in order to offset the cost of undertaking it and continue to generate profits for the company. From an investor's perspective, the cost of capital is an assessment of the potential return from acquiring stock shares or any other investment, including best and worst case scenarios. A firm's cost of capital is typically calculated using the weighted average cost of capital formula, considering the cost of both debt and equity capital. Each category of the firm's capital is weighted proportionately to arrive at a blended rate, which considers every type of debt and equity on the company's balance sheet. The cost of debt is the interest rate paid by the company on its debt, calculated on an after-tax basis. The cost of debt can also be estimated by adding a credit spread to the risk-free rate and multiplying the result by, where T is the company's marginal tax rate. The cost of equity is approximated by the capital asset pricing model, using the risk-free rate of return, the market rate of return, and beta to estimate risk. For private companies, a beta is estimated based on the average beta among a group of similar public companies. The cost of capital and discount rate are similar and often used interchangeably. The difference is that the cost of capital is determined by the accounting department, and management uses that calculation to determine the discount rate, or hurdle rate, of the project. The cost of capital is crucial for determining if funds are being invested effectively. If the return on an investment is greater than the cost of capital, that investment will benefit the company. The cost of capital can also determine a company's valuation, as a high cost of capital can lead to lower proceeds in the long run. Every industry has its own prevailing average cost of capital, which can vary widely. For example, home building has a relatively high cost of capital, while the retail grocery business has a much lower cost of capital. The cost of capital is important for businesses to determine the return necessary to justify a capital project, and to choose between different options for growth and expansion. It also affects a company's valuation and can determine if funds are being deployed effectively. The cost of capital is determined by the accounting department, and management uses that calculation to determine the discount rate, or hurdle rate, of the project. The discount rate reflects how much of a return is needed to repay the project's costs and reward the company's shareholders. The cost of capital measures the cost a business incurs to finance its operations. It's important to determine if capital is being deployed effectively and if investments will generate a return that exceeds the firm's cost of the capital used to finance the project. Here are 3 key takeaways. 1. Cost of capital represents the return a company needs to achieve in order to justify the cost of a capital project, such as purchasing new equipment or constructing a new building. 2. Cost of capital encompasses the cost of both equity and debt, weighted according to the company's preferred or existing capital structure, known as the weighted average cost of capital, WACC. 3. A company's investment decisions for new projects should always generate a return that exceeds the firm's cost of the capital used to finance the project, otherwise, the project will not generate a return for investors. Hope this would help. Thanks for watching.